In this video right now, we're going to take a look at the stock markets. We're going to ask the question, are stocks ready to correct over here? What that means, how far they could correct, what might be causing that. We'll take a look here, starting with the S&P 500. The first thing that I want you to focus in on is this shoot that we've been in, this upward trending channel over here. You can see the upper end of the resistance over here on this line. Let me go ahead and make it a little bit neater for you now that I have your attention where I want it. Starting in November of 2020 all the way to today. Right over here last week, we've been tracking this trend line. Those that are new here, welcome. If you're not, welcome back. We've been tracking this trend line over here for quite a while. It's nothing new, but I want you to focus in on it today. I want you to focus in on how we just bounced off that resistance. We looked at it coming into this resistance, and we said that's not a cause of concern. Right? It's resistance. And if it breaks and it breaks sharply to the upside, then we'll talk about perhaps a little bit of a melt up and an interim top being put in, but that's not happening. So far we have a pullback over here. The pullback so far has been about, with the S&P down 0.5% today, from the top about 1.5%, right? That's normal price fluctuation, especially off the resistance level. Last time it came to the resistance, we had a bigger correction. This was in the beginning of January, towards the end of January rather. And that correction, by the way, that was a 5.5% correction. Okay, the last big correction before that, I think that was in September and into October. Let's find out what that looked like and when that was. This was a 9.5% correction. This happened at the beginning of September. You could see down into the end of September. That was a 10% correction. That wasn't the only one. Right after that, just 30 days later in October, we had another correction, this time an 8 or 9% correction. And that's what generally is considered a correction on the S&P in the equity markets over here. About a 9%, 8% correction is considered a correction. Where would that take us into if that were to occur from the last swing high, the all-time high that we have over there? That's taking us back down towards the support we have over there at 36.23. Okay, now I'm not calling for a correction right here just because I'm seeing the Nasdaq trade off 1%, the S&P trade off 0.5%. That's normal price action for me. That's normal price fluctuation, and especially coming into that resistance right over there. The fact that we are then trading off of it, well, that's normal. That's what we expect is going to happen. Resistance is resistance until it's broken, right? At that point, if we do see, and we're not going to talk about that now, but if we do see at any point this break to the upside, we'll be watching because that's going to be an event that's very important to bring to your attention. The Nasdaq, by the way, so the S&P looks quite healthy over here. Any correction or real correction down towards the stronger support over here at 36.23, that would be an area I'd be looking to see if that support held and to look to buy off. That's when equities would become interesting. After that type of correction, will it happen in 2021 or will it not? Is the market focused in on the amount of liquidity, the QE purchases monthly coming out of the G10, or is the market focused right now on the rising yields? I brought this to your attention over the last couple of sessions. If we see yields rise over here, you can see over here the yield curve steepening, almost going vertical over here, and coming into an important level that if it takes it out, I think it's going to go much higher. This is the trade that we've been watching for. This is the anti-deflation trade, right? We see a lot of people caught up in their own nonsense. Could these rising yields put pressure on the stock market? Now, some people might think, well, you know what, they could go higher before it'll present a problem. But the market, the market being forward thinking, is the market already seeing that? Is it seeing that we're seeing yields rise? Is it seeing that they're going to go higher? And is the stock market here getting set up to correct because of it? Or is the market going to continue to ride off this liquidity wave that has been riding ever since the end of March over here when the Fed intervened? It wasn't the Federal Reserve alone. Right over here, the end of March during the dollar crisis over here, the liquidity crisis, the system was broke. The system started breaking down in September when the repo market was out of whack and the Fed had to start intervene billions and billions a day. They weren't able to stop at the end of the year. They had to keep it going up until February, up until the world went on lockdown. Talk about a crisis. The entire world went on lockdown. The Federal Reserve responded by expanding their balance sheet by $4.1 trillion. It wasn't just the Fed. It was almost every central bank in the world, with the exception of China. China is not selling out their future at this point. It's the U.S.'s turn. It's the U.S. Europe, the ECB, is not far behind the ECB. in the amount of monthly QE purchases. The Fed on pace for a $1.4 trillion in QE purchases this year in 2021. Is the market going to continue to ride off of that? We're getting see the U.S. Gov getting ready for another $1.9 trillion stimulus package, more debt. You know, is the market going to ride up on the devaluing dollar over here and the loss of its purchasing power? Or is it going to ride on the fact that rates might be rising and then correct? We'll be prepared for both, right? And if at any time equities become interesting, we're going to be there to jump on them. That's why we're monitoring them right now, so that we stay in that flow. That flow right now does not have to be constant, taking up all our time. It gets the time it deserves. Today, it's worth looking at. That's why I'm bringing this video to your attention. Nasdaq also, let's take a look at the Nasdaq. Nasdaq's off a little bit more. Nasdaq, by the way, is off maybe, let's say, 2.5% off its all-time high. You can see also the Nasdaq is riding in a nice shoot. Here's the trend line over here on the Nasdaq. Oh, I'm going to draw in a couple, really quick one, just to have a little bit of fun for you, with you. That's the first one I'm drawing in over here. I'm going to go ahead and clone this right now and raise this right above over here to get, and I can see perfect touches. Perfect touch, perfect touch, perfect touch. That's the symmetry of the market. That's how markets work. By the way, this morning, Luke was asking in the live stream how that works with the trend lines there, right there. We could only teach and learn from what the market is presenting us. I'm learning each and every day, over 20, learning each and every day. That's what I do. And I hope that makes sense to you, what we just did over here. First lining up the trend line over here. You can see this touch over here, this touch, another touch, another touch. It then broke and became support. Over here again, resistance, and then again found the support. It's a level that belongs there, but I see that we came up over here. So I cloned the trend line to find out where that was. That immediately lined up with this touch over here, and now this touch over here. Both those lines, am I gonna go down now and put in lines all the way down? No, I'm not concerned about that, because I'm not watching the equity markets closely until they become attractive. What type of pullback are we looking at here on the Nasdaq? To come, that 10%, a little more. 10, 11% into the area of support, starting at 12,443, and between this area over here of 12,143, that would be about a 12.5% pullback. Those are areas of interest if we traded down to, that we would be looking at and perhaps getting ready to enter the market long, because they would become attractive. Selling the downside, why the markets are not crashing? No, thank you. That's a fool's trade. That's a fool's trade. No, thank you. When the markets are crashing, when the markets are coming off, as they did last year, back in February, March 2019, 2020, we will be there to crush it. That's not happening right now. Everyone, have a beautiful day. I'll see you all in the morning. I'll talk to you soon.